The stock market. It can seem incredibly complicated, right? But at its heart, it's really just a powerful solution to a very old problem. So in the next few minutes, we're going to pull back the curtain and see how it all got started, and more importantly, how it actually works.
So let's start with a big question. Imagine you have a brilliant, world-changing idea. The only catch? You don't have nearly enough money to make it happen all by yourself. This isn't a new problem. Not at all. People have been trying to solve this for centuries.
It doesn't matter if you were a merchant back in the 1600s trying to pay for a super risky sea voyage, or if you're an entrepreneur today trying to build the next big thing in tech. The basic challenge is exactly the same. How do you get the money you need to turn a big idea into reality?
Well, the solution, which was invented over 400 years ago, actually became the foundation for our entire modern stock market. And it's a simple but totally brilliant concept: shared ownership.
Picture this. It's 1602, and the Dutch East India Company has a huge problem. Sending a ship on a trade voyage was insanely expensive, and just one bad storm could sink the entire investment. So their solution was revolutionary. They thought, instead of one person taking on all that risk, what if they sold tiny little pieces of the company and its potential profits to hundreds of different people? And that tiny little piece of a company, that's what we call a share. So if a company issues, say, 1,000,000 shares, and you buy just one, you literally own 1/1,000,000th of the whole business. Its buildings, its brand, everything. You own a slice of it.
Now, you've probably heard people use the words shares and stocks pretty much interchangeably, and that's mostly okay, but there is a small difference. Think of it like this. Shares are the individual bricks. You might own, say, 10 shares of Apple. Stocks is more of a general term for the whole house you build with those bricks. So you might say, I have a portfolio of tech stocks, which includes your shares in Apple, Google, and a bunch of others.
Okay, so how does a company go from being a private idea, owned by just a few people, to becoming a public investment that basically anyone can buy into? Well, that journey has a name. It's called an IPO. Let's take a company like Apple. It started in a garage, right? Owned completely by its founders. But for it to become the global giant it is today, it needed billions of dollars for factories, for research, for marketing, way more money than any small group of people could ever come up with. The solution was to go public. And this big leap from private to public happens through what's called an initial public offering, or IPO for short. It's the very first time a company offers its shares for sale on a stock exchange. This raises a huge amount of cash to power its next big growth spurt. Now, this whole process is super regulated. First, the company has to release a prospectus, which is basically a super detailed report card on its business and its finances for the whole world to see. Then, investors apply to buy shares at that initial price. After that, the company hands out or allocates those shares. And finally, the stock gets listed on an exchange like the New York Stock Exchange or the NASDAQ, and from that moment on, it can be bought and sold freely by the public. So, once a company is public, its shares are out in the wild. But what decides if the price goes up from $50 to $75 or tanks down to $30? I mean, who is actually setting that price? The simplest way to get your head around it is to think of the entire stock market as one giant, nonstop auction. Every single second the market is open, millions of people are all trying to buy and sell at the exact same time. And the price gets set by two really simple forces: supply and demand. If more people want to buy a share than want to sell it, the buyers have to offer a little more money to get their hands on it, so the price goes up. And if more people are trying to sell than buy, well, the sellers have to lower their price to find a buyer. It's this constant, real-time tug of war. So what makes people want to buy? What drives all that demand? It's really all about what we expect to happen in the future. Things like strong profits, a cool new product, or good news about the economy all play a part. But there's also something a little less concrete, just general market sentiment. The collective optimism or pessimism of millions of investors can create these huge waves of buying or selling that can push a price way up or way down. Okay, this brings us to the question you've probably been waiting for. How do you actually make money from owning a share? Well, there are two main ways this can happen. The first way, and the one most people think of, is called capital gains. It's simple. You buy a share for $50, the price goes up to $75, and you sell it. Boom, you made a $25 profit. The second way is through something called dividends. This is when a company actually shares a portion of its profits directly with you, the shareholder, as a kind of cash reward for being an owner.
So to really understand how well your investment did, you need to look at the total return. This combines both the stock's price increase and any dividends you got paid. It's the whole picture. It's important to remember, though, that while some companies are famous for paying regular dividends, they are never guaranteed. A company can always cut them if business gets tough.
So you might be thinking, okay, this all sounds great for investors, but why should this matter to me if I don't own any stocks? The truth is, the stock market affects pretty much every part of our modern world.
It's the engine that funds the big, risky ideas that lead to all kinds of progress. The smartphone in your pocket, the medical breakthroughs that save lives, the companies that create millions and millions of jobs, a lot of them just wouldn't exist without the money that was raised from millions of investors through the stock market.
Someone once called it humanity's most powerful mechanism for doing together what we could never hope to do alone. And when you think about it, that's spot on. No single person or even a single bank could have funded the invention of modern computers or the entire global airline industry. But millions of investors, all pooling their resources by buying shares, could, and they did.
So at the end of the day, the stock market is so much more than just a place to try and make money. It's like a mirror, reflecting our collective bets on what the future is going to look like. Every share that's bought is like a vote of confidence in a particular vision for that future. And ultimately, it's a system that allows all of us to have a stake in building it.